If you have over $200,000 sitting stagnant in your bank, retirement account, or home equity, then you're literally losing money. On this show, you learn how to get that money working for you consistently and conservatively. Learn to grow your nest egg with your host, Shawn Winslow. Let's dive in.
Welcome back to another Finance Friday episode. I'm your host, Shawn Winslow, and this is the Multifamily Money Podcast. What is going on, everyone? You know the deal. Every Friday, we're coming at you with tips, tricks, and strategies on how to get your money working for you harder and smarter, because after all, it's not what you make, but what you keep. And today, we have a returning guest, first returning guest on Finance Friday, probably second or third returning guest total across the whole show. Before that, you all know the fee. We don't charge to or make anything on this. We don't have any ads. The only way, we grow this show is by you sharing with those people that you think could also get value. So if you know someone who get value from this show, please share with them. And if you haven't, please leave a rating and review. That's also how we get in front of more ears. All right, everybody. Today's guest, our returning guest, Mark Willis. He is a certified financial planner. And we've had infinite bankers, or the infinite banking strategy. We've had people on before talking about this. And Mark actually talked somewhat about it last time he was on as well. That's episode 41. If you want to take a look, he goes more into detail on that episode on, kind of his background and some of the things he's doing. But today was specifically, infinite banking. And he has a different term for it, which I will let him explain to you. It's more of like a bank on you, right? Because you're essentially the bank, right? You're the whole purpose of this is, you're the bank, right? So you're taking a loan from your money, which is still paying a rate of return on the entire amount, but the amount you take out, then you can go and invest in something else and make a return on that as well. So that's where that infinite term comes from, because infinite returns, you're making it, in two different spots on the same money, blah 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 blah. But what we go over today is another strategy that he has that essentially supercharges it. He calls it his, two-step rocket approach. And he also gets into things to look out for. He says not all, infinite banking is creating equal. Sometimes it's not what it really is, and you really need to look out for that. So he gives you some, tips and tricks on what to look out for. And this is powerful. And we get into, it's not only can be used for the individual, but it can be used for a business. And we get into that and kind of open my eyes on that front, that any business could use this. So if you need it, if you're allocating a large amount of cash for your business to further grow your business, whatever you do, whether it's investing in real estate, operations for your real estate business, or maybe you sell widgets and you got to go buy a bunch of widgets, you can use this strategy to then take cash out and go buy those widgets, but you're also still making money on that money before you sell it, right? So that whatever rate of return you're still getting. And then once you go sell those widgets for a profit, then you're making even more money. And it's the same thing with real estate. So, all right, I'll let him explain it better than I just did. But without further ado, here is Mark Willis. Hey, Mark, welcome back to the show.
Hey, thanks, Shawn. Glad to be back.
You're one of the very few, and by very few, I think the second or third person that's ever been a returning guest on this show. So listeners, if you weren't here for Mark's first one, which is episode 41, definitely go back and listen to that. But this also just shows that, Mark brings some quality. So, I wouldn't invite everyone back. So, and for guests that have been on the show, hopefully you're not listening, but that's that some I would for sure, but Mark is one of them. And he just brings some quality content. So today, we're going to take the listener on a nice ride in terms of infinite banking, and maybe possibly there'll even be a part 2, but we'll see how that goes. But before we get into that, Mark, if you don't mind, just do a quick overview of yourself, who you are, what you do. Obviously, you don't have to go into too much detail because we did that in episode 41, but just give them a quick overview.
Yeah, it's sort of like those Saturday Night Live hosts. They just seem to keep coming back, some of them. So I'm glad to be among the rarefied, esteemed guests, and it's a privilege to be back. So thank you, Shawn. I'm a certified financial planner. but folks have begun to call me the not your average financial planner, because we tend to bring people to solutions and strategies that are not typical for, investment gurus, stock jockeys, tax accountants, and so forth. But we use time-tested financial vehicles that have been around for generations, hundreds of years, sometimes even longer, to help people reach their financial goals without taking a bunch of unnecessary risk. We seem to specialize in working with real estate investors in particular, those that are doing passive deals or active deals. And I just love getting to do creative solutions that really move the needle for folks, not just on this deal or that deal, but for all the rest of their financial life and even for future generations.
Yeah, Mark, and personally, so I come from a finance background, and personally, I feel financial planner of the future is going to be like Mark here. They need to be creative, think outside the box. It's not just the old, vanilla investment strategy. Let's do a, the 60-40 split and call it a day. Like that's not how we should do things anymore. That's probably not even how we should have done things back then, but I digress on that. But Mark, let's just get into it. You were talking about a strategy using infinite banking. We talked about infinite banking last time, but this strategy is different. And you said it really pertains to real estate investors. So let's get into it.
Sure. Well, I'd like to start first, if I may, at kind of a distinction I've begun to realize and now make for my clients when we're considering this strategy. So the first thing I want to say, again, as a fiduciary and as a certified financial planner, I can't just go recommending folks just jump into any strategy, 60-40 split on stock and bonds or real estate or infinite banking or any of it without proper due diligence, right? So I got to get that disclaimer out of the way. But it's also true that not all infinite banking is created equal. I've begun to realize this. In fact, I now call it the all-natural peanut butter in the grocery store because anybody can use the words all natural.
Yeah.
But it doesn't necessarily mean you're getting USDA organic. So what I did was I dug around and found a training and certification credentialing process known as the Bank on Yourself program, the Bank on Yourself Professionals Training and Credentialing Program that has for now over 20 years segmented out a part of the infinite banking world and said, all right, these are guys and gals, financial professionals, tax accountants, financial planners, insurance agents that are doing it right. And by right, we mean the specific way that Nelson Nash, the guy who started infinite banking, and Pamela Yellen, who founded the concept and training program, Bank on Yourself. So anyway, I went through that training program, and all of my colleagues and advisors that I work with and are peers with me have gone through it as well. And boy, I will tell you that it makes a big difference. It's sort of like when you get into an elevator, all you want to do is get in and push the button and up you go. But if you get into an elevator that was not engineered correctly by a certified service technician, elevator technician, I don't know. I wouldn't get into that elevator.
Yeah.
And the same is true with these policies. If it's not engineered correctly by a certified Bank on Yourself professional, then you might have it growing too slowly. It could lose some of the tax advantages. It could be riddled with fees. It could even be, I've even seen people think they had infinite banking policies, and it ended up they were still tied to some sort of stock market index, or worse, a variable fund that was very loaded up with fees and sub-account expenses and more, and even running out of cash as they get into retirement. So that's kind of the dire warning, I guess, I'd like to share as we get into our episode today. Though there's some great news on the other side of that, but you just got to make sure you're working with a trained, competent, certified professional with Bank on Yourself. That I'd say is the only credentialed program process that I could find in this niched part of the financial universe. So that's kind of the disclaimer. So very, very briefly, what the heck is Bank on Yourself or infinite banking? I'll call it Bank on Yourself today, if you don't mind, just to make that distinction. Bank on Yourself is a modernized form of dividend paying whole life insurance that allows us to have a death benefit, sure, but the real focus for most of our real estate clients is the cash value and what it allows us to do. So this cash value is living benefits, not a death benefit. And I always joke and say it's a lot more fun to spend money while you're alive. All right. So by packing money into the cash value, you can spend money while you're alive and use it for whatever you want. That cash value is liquid. and accessible, and usually done with some significant tax advantages, so you can get access to the money for any reason. There's no prohibitions, there's no prohibited transactions like there are with self-directed IRAs. You can use the money for your own kitchen remodel or to buy a storage unit or whatever you want to do with the money. All right, so now that that money is accessible to us, we also want it to grow for us. And it does. It grows at a competitive rate, usually in the middle single digits. So it sure beats my savings accounts, my money market accounts, my CDs, but it's not supposed to be an investment. So that's a distinction I like to make too, is that this is a cash alternative in your portfolio. It's not meant to replace your meme stocks in your portfolio, all right, or your crypto. So it's a safe, predictable, liquid, tax advantaged, growing at a nice conservative rate. Usually it'll over time keep up with inflation. So in fact, side note, if we continue to see these high interest rates, Shawn, I fully expect the dividends on these policies to actually push up the dividends will go up if interest rates continue to stay high like they are right now. So we'll actually benefit from higher interest rates, unlike maybe say our mortgage rates, which we've all seen those go up over the last year or so. Okay, and then lastly, and then I'll hush and get your feedback. We can borrow against this cash value. It's essentially like a guaranteed line of credit from the insurance company. And let's say we've got $200,000 of cash value in one of these policies. And let's say we want to borrow 170 grand, let's say, to invest in a syndication deal or whatever else we might want to do with the money. We can borrow against that policy, and the insurance company will give us a full increase, guaranteed increase of our cash and a full dividend, not on the remaining 30 grand, but on the full $200,000, even on the capital that we had borrowed out to go invest in a deal or fix up our house or whatever we were planning to do with that cash. So this gives us incredible arbitrage because it gives us the growth inside our policy, but it also gives us the chance to, get some sweet deals in the real world as well with our real estate or anything else we might need that money to do for us.
And that's probably one of the most powerful things about it too. And that's probably where I know you're calling it the bank on yourself strategy, which is probably a better term, but that's where that infinite banking came from. Even though it's not technically infinite, but I see what they mean. It's you're making multiple returns on the same money. That's what's the most powerful thing to me. And correct me if I'm wrong, you technically don't have to pay that back, right? If that 170, but what happens if you die, then the death benefit is decreased by that amount. Is that correct?
Yeah, that's very well said. Yeah, there's a death benefit tied to this whole thing. And a lot of folks ask me, well, Mark, why does it have to be life insurance? Can't we just do this with something more sexy than life insurance? And I'm like, if there was anything else that could, believe me, if I could talk about anything besides life insurance, I would be talking about that instead. And nothing kills the party more than talking about, life insurance. But yes, it must be life insurance, and it must be dividend paying whole life insurance. And it must be a non-direct recognition loan from a mutually owned life insurance company. So with all that mouthful out of the way, yes, if I borrow from the policy, back to our numbers that I just gave, let's say, for example, your death benefit was 800 grand and you borrowed against that life insurance to go buy your syndication deal or whatever. And again, you borrowed out 170. That means you'd have, what is that, $670,000 as a death benefit? Your 800 minus 170. It's the afternoon, so my math in my head, that's about 670 grand. 670, yeah. You'd still leave your family 670. And also you'd leave them the syndication deal too.
Right.
So you're made whole one way or the other. Now you're right. You don't have to pay back the loans, but it's recommended. You're on your own schedule for how and if and when you pay off the loan. But there is interest on these loans, and you don't want the policy to lapse necessarily because you'd lose the life insurance, and there could be taxes due if there were gains. But in all my years of doing this now, with over 1,000 clients in all 50 states, I don't think I've had a single person lapse a policy with any of those consequences I just mentioned. It's sort of like I could drive my car straight into a tree, I guess, but I just avoid it. And so thereby it doesn't happen. It's easy to avoid these issues as long as we're watching it. And thankfully, with such predictability and even guarantees built in, it's very rare for someone to run afoul and lapse a policy like that.
Right. And if you're investing in a syndication or some type of other, real estate investment, private placement, whatever it happens to be, there should, if you're doing it right, there should be that delta between the interest on the money you took out, and then the return you're getting from the investment, which, it should be greater. So then you're able to pay that off and then some. Generally, what is that rate? The rate on the money you take out, is that like based on like a prime rate, SOFR? What do they base that on?
Do you want the short answer or the long answer?
I don't know.
All right. I'll give you the short answer first. Let's say that it's typically a 5% simple interest all year long, and they only compound it annually in arrears. Now, what does that mean in plain English? It means if you were to borrow from the policy and pay it back over 4 years, let's say that we had this syndication, and after a 4-year period, we cash out or we refi or whatever, then the annual percentage rate on that experience, borrowing and then paying it back over 4 years, I've done the math on this a number of times. It's about 1.9% APR. That's now everybody's numbers are going to be a bit different there, but that's generally speaking, if it's a true bank on yourself policy, that's about what you can expect. Consult with your own professional, of course, to get details, but that's the interest paid. And in fact, I can even give you an example if you'd like. Would it be helpful if I gave some real live actual numbers? This is kind of cool. So this is getting into the 2-stage rocket idea that you and I talked briefly about. So let's say that a guy has a large lump sum of $400,000. Now, in this case, he has one lump sum, and he just wants to dump it in, and he doesn't want to deal with this monthly premium stuff, and he just has a lump sum, and he wants to put that money to work in a multifamily deal right away. So he puts in $400,000. He's 40 years old when he starts this. He puts in $400,000, and in the first year, I'm looking at the math here, he's got a cash value already of $378,000.
Wow.
That's pretty darn good for life insurance. Yeah. And a death benefit, not to dismiss the death benefit here, he's got a death benefit of $1.7 million tax-free. Wow. So that's 90-ish% of his money right away in cash value, and 4 times his money as a death benefit in the first year. So right away, 30 days roughly after he starts the policy, he can borrow out against that cash value, roughly 90%. He borrows out $360,000 in the first year, $360,000, and he decides he wants to pay it back over 8 years. So maybe his syndication deal is wiped out after 8 years, however they exit the deal. Okay, so if you're keeping up with me, I realize we're doing some numbers on a podcast here. But in the 8th year, his policy continued to grow, even though he had borrowed basically everything out of his policy. His policy went from $378,000 to $507,000 in 8 years. Wow. That's pretty darn good for cash, right? That's over $100,000 of growth in just 8 years. And if we count the cost of insurance there, the total growth was $107,000. Now, he did pay some interest to borrow that money out for 8 years. The total interest that he paid over that same period was only $54,000. So if you're keeping track at home, he paid $54,000, which is a 2.1% APR.
Cheap.
For those interested. Not too bad, right? In today's rates. He paid $54,000. He earned $107,000 while that loan was outstanding. So that's the sweet arbitrage that we like to look for. And in his case, that specific example was $53,700 of arbitrage in that case. So there's a step 2 here, but before I move on, why don't I pause for a second? What feedback or comments or questions?
No, that's great. And that just shows how, you're banking, like the name of it, you're banking on yourself. You are being the bank. You're doing exactly what a bank would do when you make a deposit. They would then immediately take that money and go lend it to someone else and make, interest on that. And it's a game changer for people. So if you want to get into step 2, let's do it.
Yeah. All right. So, there's a single premium policy out there. That's what we just described. And a lot of people will notice those that are really into this will notice that single premium policy runs afoul of some tax advantages. All right. So the single premium policies have some just different tax environments that they live in relative to normal, maybe annual recurring premium policies. Okay. So I want you to imagine for a minute, let's get rid of life insurance and let's just talk about rockets because those are a lot cooler to talk about. So, I'm definitely not a rocket scientist, so this is going to be very crude, but I imagine 2-stage rockets. Back when I was a kid, I'd watch those NASA shuttles take off, and there was the 2 side thruster rockets, and they would sort of eventually they'd fall away, and then there was that central tank that would just shoot them off into the stratosphere. I kind of imagine that as I described this. So imagine a big rocket sitting on a launch pad, and it's a 2-stage rocket. The first stage lifts us off of the launch pad, instant liquidity, instant growth, instant thrust, and gets us over that initial inertia of gravity and gets us going into escape velocity, right? And then at some point, boom, like, little burnt out candles, the first stage rockets fall away. And now we got our main turbo booster, whatever you want to call it, that really shoots us off into space. So that's stage 2. Okay, so back to our guy here. He's 40 years old. He put in his large chunk of cash of 400 grand. And hey, side note, you can take a 0 or even 2 zeros off this and it still works. So don't feel like you have to come up with 400 grand to get one of these going. All right, but let's just use these numbers.
And can you add to it too over time?
Yeah, you can. So this first stage rocket is a single premium. Just drop it in his case, but you are able in some cases to add more to a single premium policy. So in this case, the 400 grand drops in and it's instant liquidity. It gets him off the launch pad. He's doing deals in the first few months, and he's having some fun with it right away. At the same time, he's also packing away money into a recurring premium policy. And in his case, he could set aside, $3,000 a month that he felt like he could do from his real estate or whatever. But remember, you could do $300 a month as easily as you could do 3,000, and you could do 300 grand a year if you wanted to. So it really is custom designed to each person's personal situation. You don't have to do these exact numbers, but in his case, he was able to put away $3,000 a month along with that one-time lump sum. And that $3,000 a month is going into a tax-free policy, a non-MEC policy, as it were. And that is sort of just waiting in the wings. It's like our stage 2 of our rocket. So it's, again, we're lifting off. We've bought the syndication deals. We bought the storage units, whatever it is we bought with that large single premium. And we're doing all sorts of deals with that. But we're also on the side secretly funding this other recurring premium policy. And after about 4 or 5 years, let's say, we really have a nice juicy cash value. In this guy's case, he had 6 figures of money in his policy in just 4 years. So he starts to draw on that as sort of another place to access capital and to pack away capital. And I'll back up and say, hey, your money needs a place to live.
Yeah.
It's got to live somewhere. And what is the likelihood that you're never going to have another deal or another windfall after the one you got just last week or last month or last year? It's very likely that you're going to keep having these windfalls happen to you over your lifetime, whether it's monthly stuff or large lump sums. So we got to place our money somewhere. It's going to live either in the markets or in real estate, or it's going to live in, and all I'm saying to consider this bank on yourself strategy is before it goes into the markets or before it goes into real estate or goes even to your tax bills, consider putting it into a policy first and then accessing that money for all the things you might need in life, or at least the major expenses. So that's kind of the idea of the 2-stage rocket. The first one is being used heavily in the first 5-10 years, let's say, where there are no taxes needed on MEC policies in the first few years. And then a recurring premium policy is really our workhorse for the rest of our life. He's able, in this guy's case, to have significant amount of income. He just stops funding it after 18 years, and he's able to pull out almost $3,000 a month for the next 30 years in this guy's case. And not to mention the real estate deals and all the the money he's getting from those real estate deals. So it's kind of a collaborative effort. You put several different policies together to make it all work, but it's an incredibly efficient way to use liquid money to buy your deals, do your due diligence, get some tax advantages in the meantime, and get out into space.
There we go. And are you getting paid a dividend on both stages?
Mm-hmm. Yeah.
Okay.
Yeah, both of them are generating a significant dividend. And just case in point, in the 20th year, the first policy, our stage one, is doing about 30 grand a year on its own. So even if you didn't spend down the money, you could just take about 30 grand off that one. And it looks like he's taken about almost $35,000 a year off of stage two. So you add those two together, and that's something close to 60 grand a year of money that he's pulling just, looks like about 20 years after he starts these policies.
Plus whatever passive income you're making from your investment, the money you took out.
Hopefully you didn't blow this. Hopefully you didn't blow this at the casino and you put it into smart investments and you've got,
or buy a car or a boat or something. Hopefully you didn't do that.
That's right. That's right. I mean, if you do this right, we're looking at 6 figures of income. Some of that would be tax-free. Most of it would be tax advantaged. And then of course the real estate has its own beautiful tax system as well.
And can you, this may be a question for a CPA, but when you get your passive loss from depreciation, when we do cost segregation on our properties, you get a hefty amount of depreciation. Can you use that against the dividend? Is that considered?
Dividends are not necessarily
passive income.
Yeah, they're not considered passive income, but they're also, unlike a brokerage account, this is good for the financial geeks like me and you here, but dividends on stocks are taxed differently than dividends on life insurance, because in the technical tax parlance, a dividend on life insurance is simply a refund of premium. Okay. And I like that because it's not technically it's not like a stock dividend, right? So there's no capital gains on it. And so if we do it right, especially on non-MEC recurring premium, the stage 2 of our rocket there, we can actually get access to both principal and gains through a combination of withdrawals and loans, 100% tax-free is how the tax law states it. And that's been the way it's been for as long as we've had an income tax in this country.
There's another benefit, people, right there. We love those tax advantages.
Yeah. Now on the MEC policy, it is taxable on gains. Gains are considered taxable on our income tax rates. So how do we avoid that? Well, either we don't take money out of that policy and we just use it for a giant tax-free death benefit. Because think about it this way, and again, I'm going to go a little deeper because I know I got some financial listeners here. But let's say that we've got a bunch of rental properties in our 30s, 40s, and 50s, and we're accumulating all these rental properties, and we're depreciating them in our younger years. Yeah. And we fully depreciated them by the time we get to retirement. But I assume we're going to still collect rent in retirement. At least I hope you will. So that rent money is now fully income taxable to us because we have nothing left to depreciate, right? So what can we do? Well, if we do this right, we can live on the life insurance that's tax-free, donate or give to a revocable trust or irrevocable trust our rent money, and then leave everything to family, friends, charity, whatever, without, and even get a tax deduction on that rent check that we were going to be taxed on. So there's lots of wonderful, creative ways to do this. You're right, I'm not an accountant, but as a certified financial planner, we can at least, kick around some ideas and then you can bring it to your CPA.
Love it. Hey, you learn something new every day. And I love when that happens.
Yeah. Always learning.
And Mark, why aren't other people doing this? What are some of the things, obviously people should go to you if they're looking to do this, but we know that's not necessarily going to happen on every person, but what should they be looking out for with other products that, claim to be similar, but they're not?
There are 400,000 life insurance agents in the United States that I can calculate and find. So that's one for every 800 Americans, Shawn.
Wow.
So that does not mean that all of them know about anything that you and I just talked about.
Right.
The 2-stage rocket, what is that? They don't know. So the first is, again, back to the elevator metaphor. You want to make sure you're getting in the right elevator and it was designed correctly. If it was designed correctly, all you do is get in and up you go. right? But if it's designed incorrectly, look out below. So that's the first reason why most people don't do this, is because there's just not enough trained, competent bank on yourself professionals that know what they're doing here. The second is there is a large lobby all over the place encouraging us to do anything but life insurance. There's a reason why the movie was called The Wolf of Wall Street. All right. So there's trillions of dollars in qualified IRAs, 401ks, and mostly tied to the market, right? And there's a reason for that. That wasn't the case until 1974, when ERISA was passed in this country, and we became really a nation of investors. Before 1974, most of Americans saved money in whole life insurance, annuities, that sort of, in savings accounts and CDs and that sort of thing. But after 1974, there was a big push into Wall Street. We don't have time to probably get into all that, but that's at least a few of the reasons why. I would also say, candidly, this is a long-term financial vehicle, Shawn, and most people, some people, are really going to want tonight's rate of return.
Yeah.
So in the first few years, these policies are not giving you like double-digit returns. They'll probably never give you double-digit returns necessarily over the long term. Like I say, single digits is pretty common, middle single digits. And some people just can't handle that kind of patience. They want it all right now, and that's going to exclude them from this strategy, unfortunately for them. Because again, like you and I have been talking about, it's not either or. It's not either I do whole life insurance or I get into real estate or I do stock market or whatever. It can be both and. If we do this right, we get both the whole life policy designed correctly, and then we can access that money to go do whatever else we need our money to do for us.
Yeah. And I think that's what sets it apart. And I think it's you just got to get to know the person you're dealing with. So if you're working with Mark, obviously got to get to know them, because I've heard of, what they claim to be this type of product, and maybe it is to a certain extent, but within the first year, they're, what they can access is only like 50% of the cash balance or less, and that's obviously advantageous for one person, and that's not the policy owner.
That's right.
So yeah, I think you just got to look out for that. But otherwise, this is a great product that can create a lot of benefits for you as the investor. And to Mark's point of, yeah, it's just like real estate. It's not get rich overnight. It's get, really wealthy over a long time. And the great part of this is that you can take money out and then go invest it in something else to then, get an extra return on that money, which that's the most powerful part.
Couldn't have said it better myself, Shawn. That's great. Yeah, it's all about the way we think. If we think like a debtor, we're going to stay in debt. If we think purely like a saver, we're going to merely be saving and then spending. But if you can think like a wealth creator, you can lift off from the launch pad and head out to space.
Love it. Is there anything else you'd want to add to that strategy that you can think of, or anything else any people should look out for?
I guess one last piece just for fun, these policies get more and more efficient over time. So they grow literally on a straight line in a compound fashion. So this is unlike the volatility of the markets, where things can go up one month and then down the next month. When you have true compounding, it's not supposed to have volatility, but the market gives us volatility every day.
Right.
So with this becoming a more and more and more efficient J curve, the arbitrage gets better later on. In fact, I'll just do a final comment and note on that two-stage rocket. Back to that first example, right? He borrowed out the money, and his arbitrage was $53,000 at the end of year 8, if you recall.
Yep.
So he's like, man, that was awesome. I want to do that again. So he takes another loan and goes another 8 years. But in that case, in the second 8-year period from year 9 to year whatever, what is that, 17, I guess, his arbitrage has doubled to $107,600, just because the policy has gotten a lot more efficient over the preceding 8 years. Okay, so why am I saying this? I'm just saying these policies, as they get more efficient, you're able to do more and more with them. They become a bigger and larger line of credit for yourself or your business.
Oh, that's awesome. And correct me if I'm wrong. You might have mentioned this, but is that taking into account the return he got from the outside investment, or is that simply?
No.
So yeah, that's the powerful part. That's $100,000 spread, but that he could have made another like 500,000, 400,000 somewhere else.
Mm-hmm.
Yeah, or more.
Yep. You just increase your yield without any additional real estate market risk. That's what it boils down to.
Yeah. Love it. Love it, Mark. And are you able to do this with a business entity? Say you have like an LLC with a partner and say, you want to put, 400,000 like this guy into something like that. Could you do that?
Yeah, we do it all the time at our firm, Lake Growth Financial Services, all over the country. Business owners are calling us, people who have 50-50 partnerships, LLCs, S Corps, LLCs, C Corps. You're able to have the business own the policy. That's easy for us to do. And the business then has that asset on the balance sheet of the business. So do you think that'd make you more attractive to typical mortgage companies, et cetera? Yeah, you bet. If you've got several hundred grand on cash.
What's the asset based off? Is it based off the death benefit or is it based off of the cash value?
Well, wouldn't it be nice if it was that giant death benefit? No, it's unless the banker is going to off you right there in his office. It's based on the cash value when you walk in the door.
Okay. But it's the cash value, but does it take into account whether you've taken a loan off of it or no?
Whatever your cash value is when you walk in the door of the bank, let's say it's 500 grand. That's pure liquid cash. And banks love seeing cash value life insurance on the balance sheet. It's like working capital that you can use as a contingency fund, and banks love to look at that as very secure, tier one asset. Banks are some of the biggest purchasers of these policies, by the way. So look up how much Bank of America, for example, has in cash value. It's in the hundreds of billions of dollars.
So if it was $500,000 cash balance, but you took out $400K the week before you saw the banker, then it would only be 100.
That's right. Yeah.
Okay.
Yeah, but again, you'd have a $400,000 asset somewhere else in your business.
True. Yeah.
Maybe it's not liquid though.
That's why don't go buy that Lamborghini, folks. Go buy an asset.
That's right. Unless you can write off the Lamborghini.
Yeah, or unless somehow that thing went up in value somehow.
That's right. Hey, some of these used cars are some of these used cars like even our normal drive around the town cars are some of our best performing investments this year. So I'm seeing.
Yeah, it's crazy. I know someone who just had a car for 2 years, went and got the same car again and did, not taking into account like gas and insurance and all that, but it was pretty much just a wash.
Wow.
Brand new car. And it makes sense, right? There's no inventory. They need stuff to sell. So they're going to take your used car if it's in good condition, low miles.
Right. Well, two quick things, and I'll keep this brief because I know this is sort of off topic of real estate, but one, I just drove by a local dealer here and the lot was 100% empty, which I've never seen that before. And then two, I just had a guy on our podcast, Not Your Average Financial Podcast. His name's Marty Smith. He was visiting a car dealer in his hometown. He was just talking, just shooting the breeze with this guy. He's 32, 33-year-old owner of a car dealership in a small town, New Jersey. And he had, $500,000 of inventory just sitting on the parking lot, just cars, right? Just sitting in the parking lot. And Marty, my colleague and friend, he says, "Well, how'd you buy all these cars? Well done being an owner of a business at 32 with $500,000 in inventory. How'd you buy the cars?" And the owner says, "Well, I paid cash for them." Well done. You didn't have to go into debt to buy them. But he said, "But what if there was a better way than even paying cash?" And the guy's like, "Well, what do you mean?" He said, "Well, how much did the bank pay you in interest when you spent your money to go buy all these cars?" And the owner's like, "Well, stupid. Obviously, the bank doesn't pay me anything when I withdraw my money out." And Marty says, "Well, what if you had borrowed from your policy to kind of cut to the chase? If you had borrowed from your policy to buy $500,000 of inventory, you'd be making money while the cars are waiting for people to buy them on the lot there."
So smart.
Guy's like, "Wow, why haven't I done that?" So anyway, that's just one more example of the infinite ways we can use this policy.
Yeah, so that makes a lot of sense. So if you're any type of business, right, you have to buy a certain product in a market like today, you want to buy it in cash. Maybe you have to buy it in cash depending on the vendor. You might have to. Instead of just taking cash, buying it, now you're not making anything on that money. You just have the inventory. Hopefully you can sell it. Instead of doing that, you put it in this type of whole life policy, and then you take a loan based off the cash value that then you can go and buy that product. Let's say it's a pen, right? You sell pens. You go and buy those pens. That say you buy $400,000 worth of pens.
Mm-hmm.
If you just did it with cash, there goes that $400,000 until you sell those pens, hopefully for a profit. This way, you're actually making money on that $400,000 even before you sell the pens. And then you sell the pens, make a profit on that as well. And then you put
Beautiful.
it back in and then just rinse and repeat.
Recycle the money. Don't throw it away. Yeah. Well, and I love what you're saying. And think about it too, because we all live in the environment with our competitors or our colleagues doing the same thing. As if you're 7 other guys and gals also selling pins, think of what they're having to do. They're on credit cards. They're on lines of credit with their business. They got to sell those pins at discount to make their sharks happy, the banks happy. Meanwhile, you can sit and wait for the price to come back up again, sell at a higher margin. You'll beat those guys just by default when you're your own banker rather than having to kiss the ring of the banker down the street.
It's next level. So is there a limit to how much you can put in? And if there is it different between like a business entity and then an individual?
Good question. Smart. Because technically, no, the government doesn't limit us. Thank goodness. Unlike a Roth IRA where they really cap us out, which, in some ways that's a shame. But there is no government limit to how much insurance we can buy. The only limit is how much do you want to put in? That's one limit. And 2, how much will the underwriters at the insurance company approve you for? And you can have as many policies as you want on other people that are connected to you financially somehow, like a business partner or a family member, but you yourself can have 1 mega policy or 10 small policies as long as there's not too much death benefit and there's a calculable number for each person. Everyone's got a little number floating above their head, Shawn.
Yeah.
And only underwriters at insurance companies can see this invisible number.
Those actuaries, right?
That's right, man. You got it. Yeah, the nerds on the playground. But those numbers are important, and we look at that before we apply to make sure we're not over-insuring or under-insuring. But the key is not the death benefit. The key is squeeze that death benefit down super hard. Still, it's nice and big, but it's small as we can make it, and flood the policy with as much cash as possible. Cut the commissions and flood that thing with as much cash as possible.
So those are the levers you can use. If you want a larger death benefit, then it's going to reduce your cash balance and vice versa. Okay. Wow. That's very interesting. And from your experience, are many businesses doing this?
Everyone I can talk to at least knows about it as an option. Yeah. Okay. There's a guy there's a guy doing a 7-figure painting business. He's using it for his trucks, his paint inventory. He's using it for employee benefits. I've got a wonderful number, almost 100 client families that are doing e-commerce online, selling online products and so forth. Of course, real estate is a big deal. People will use this in many ways for their real estate projects. Anything you could possibly imagine. Whether you're a product business or a service business, you could probably find some benefit because everyone needs cash. So, and everyone typically has large expenses at some point. So how are we going to buy that thing, whatever it is?
Well, Mark, this has been great as usual. Before I let you go, where can listeners find you?
Well, if you'd like to dig into this further, again, we can only do so much on a podcast, right? You've been very gracious to let me throw some numbers around. So hopefully folks were able to jot some of those down. If you'd like to dig into this further and see how you could become your own banker and become your own source of financing, I'd be happy to chat. We can do a 15-minute conversation. We can get you connected to the right people who are Bank on Yourself professionals. Just go to kickstartwithmark.com. So that's kickstartwithmark.com.
I love it. And if you're interested, I highly recommend you reaching out to Mark. I know he'll take good care of you. And Mark, thank you for coming on here and sharing again. You brought the heat like last time. You brought the rocket fuel. Hopefully we'll send some people to the moon, right?
That's right, man. Hey, you and me, it's like nitro and glycerin. Let's do this thing.
Let's do it. Yeah, I think we'll probably even have you on again. So the trifecta coming to not a screen, a headphone or speaker near you.
Sounds great.
All right, Mark. Thanks.
Thank you.
And listeners, easy doesn't pay well, and instant gratification is self-destructive. So you got to get out there, not only work hard for your money, but have your money work hard for you, maybe even with some bank on yourself, so you can get out there, create the life of your dreams, and we can all make the world a better place. All right, I'll catch you on the next one.
Hey, this is Shawn Winslow. After being in the financial service industry for years and having candid conversations with good people just like you, I realized that so many of us are wanting an investment strategy that provides solid returns and consistent income without the bumps in the road. There's little known secret that your financial advisor doesn't want you to know. There is investment out there that is less volatile and the returns are stronger. Get more details by going to greenbriercg.com and clicking on the free e-report. And by the way, if this show has provided you any value, then feel free to leave an honest written review and of course share it with a friend who needs it. See you next week for another great show.